You're scrolling through luxury listings, seeing six-figure watches and seven-figure cars, wondering if there's actual money to be made here or if it's just rich people trading toys. Here's what nobody tells you. There's a hidden market operating behind these assets, and the people profiting aren't the ones you think. They're not collectors, they're researchers who figured out what information is actually worth something. Most people approach luxury assets completely backwards. They see a rare Patek Philippe or a vintage Ferrari and think the value is obvious. It's rare, it's expensive, therefore it's valuable. Wrong. The actual value is in knowing what makes one $200,000 watch worth $400,000 next year, while another identical model stays flat. That gap, that's where money gets made. And it's pure information asymmetry. Let me show you what this looks like in practice. There's a specific Rolex model, the Daytona Ref 116500LNN white dial. Retail price when it launched was about $13,000. Sounds expensive, but people who understood the research were buying these at retail and flipping them immediately for $30,000 to $35,000. No restoration, no waiting, just pure arbitrage based on knowing demand patterns that most people completely missed. That profit didn't come from luck, it came from tracking authorized dealer allocation patterns, understanding which markets had wait lists and which didn't, monitoring gray market pricing across different countries, and recognizing that demand was outpacing supply by a ratio that made the premium inevitable. Most people saw a watch. Researchers saw statistical certainty. The luxury asset world runs on information gaps. Massive, exploitable information gaps. And the interesting part? These gaps exist because most participants don't want to do actual research. They want stories. They want heritage and craftsmanship and brand mythology. All of that matters for marketing, but it's mostly useless for profit. What actually matters is data nobody else is collecting. How long do specific models sit in dealer inventory before selling? Which auction houses consistently undervalue certain categories? What's the correlation between currency fluctuations and cross-border pricing differences? When a brand announces production changes, how does secondary market pricing react in the following 90 days? These questions have answers, specific, measurable, profitable answers. Here's where it gets counterintuitive. The most profitable research isn't about finding undervalued assets. That's what everyone tries to do. And the competition makes it nearly impossible. The real opportunity is finding overvalued assets before the market realizes it. Because when something drops from artificially inflated pricing back to rational levels, the people who saw it coming can short the market or avoid losses that wipe out other players entirely. Take the classic car market in 2022. Certain air-cooled Porsches were trading at absolutely insane multiples. A 1973 Carrera RS that sold for $150,000 in 2015 was suddenly worth $900,000. People called it passion, investment, scarcity. Researchers called it a bubble waiting to correct. And when it did correct in late 2022 and into 2023, values dropped 30 to 40% in some categories. The money wasn't made riding the bubble up. It was made recognizing the peak and getting out before the fall. But here's what makes luxury asset research genuinely different from other markets. Traditional financial assets have transparent pricing, regulated exchanges, public data. Luxury assets have none of that. Prices are negotiated privately. Sales happen off-market. Actual transaction data is closely guarded. This opacity creates opportunity, but only if you know how to extract signal from noise. You can't just check a Bloomberg terminal for luxury watch pricing trends. You have to build your own data, and most people have no idea where to even start. They think research means reading brand forums and following Instagram accounts. That's not research. That's entertainment disguised as education. The actual work involves tracking private sales, monitoring auction results across multiple houses, analyzing dealer inventory turnover, correlating macroeconomic indicators with specific asset categories, and building historical pricing databases that don't publicly exist. It's tedious, it's time consuming, and that's exactly why it's profitable. Because the barrier to entry isn't money, it's effort, and most people won't put in the effort. What I'm about to show you next changes how you see every luxury asset you encounter. Because once you understand the specific data points that actually predict value movement, you stop seeing objects and start seeing opportunities that most people walk right past. The first data point nobody tracks properly is time on market, but with actual precision. Not this sold recently or that's been available for a while. Exact days. When did a specific piece first appear for sale? How many times did it get relisted? How long between listing and actual transaction? Most dealers won't tell you this directly, but you can reconstruct it. Screenshot listings when you see them. Note the date, check back weekly. When something disappears, mark it. When it reappears 3 months later at a different dealer or auction house, that tells you something important. It tells you the first attempt failed. And if you're tracking dozens or hundreds of these data points simultaneously, patterns emerge that predict which categories are losing momentum before prices visibly decline. The second metric is geographic arbitrage that most people completely ignore. A Patek Philippe Nautilus doesn't cost the same in Geneva, Hong Kong, and Miami. Not even close, but the differences aren't random. They follow predictable patterns based on currency strength, local tax structures, import duties, and regional demand concentrations. When the dollar strengthens against the euro, European luxury pricing becomes effectively cheaper for American buyers. But there's a lag. Dealer pricing doesn't adjust instantly. That lag is where money gets made. You can buy in markets that haven't repriced yet and sell in markets where demand is concentrated. This isn't theoretical. People do this systematically with 6 and 7 figure profits annually, but only if they're actually tracking the data rather than guessing. Here's the part that surprises people. The most valuable research isn't about rare pieces. It's about volume categories that trade frequently enough to establish statistical significance. A one-of-one prototype watch that sells once every 5 years? Impossible to model. A Rolex Submariner that sells 500 times per year across multiple channels? That generates data you can actually use. You can calculate mean transaction prices, standard deviations, seasonal patterns, correlation with broader economic indicators. And once you have that foundation, outliers become obvious. When something trades 15% below the established range, you know it's mispriced. When something sits unsold at 20% above range for 90 days, you know the seller is delusional and that piece will eventually correct downward. The third critical element is understanding authentication and condition grading as a data problem, not a subjective opinion. Most people treat condition as vague descriptors. Excellent, very good, fair, completely useless. What actually matters is specific, measurable condition factors that correlate with price variance. For watches, it's case thickness measured in millimeters, dial patina, assessed against photographic references, movement service history, documented with receipts, originality of components, verified through serial number databases. For handbags, it's corner wear measured in centimeters, hardware plating, loss quantified by percentage, interior lining condition scored on standardized scales. When you start measuring instead of describing, you can model exactly how much specific condition issues affect value. And that model tells you when something is priced incorrectly based on its actual condition versus how it's being marketed. Every major profit in luxury assets comes from information asymmetry. You know, something the other party doesn't? The seller doesn't realize their piece is rarer than they think. The buyer doesn't understand the market is shifting. The auction house doesn't recognize that comparable sales data they're using is outdated. And the only sustainable way to maintain that information advantage is research that never stops. Not reading, not following, researching, building datasets, testing hypotheses, tracking outcomes. Most people won't do this because it's work that doesn't feel like investing. It feels like accounting. But that's the entire point. The people making real money in luxury assets aren't the ones with the best taste or the biggest passion. They're the ones treating it like the data-driven market it actually is. And once you see it that way, everything changes. So here's what separates profitable luxury asset research from expensive hobbies dressed up as investing. It's not about developing better taste or accessing exclusive circles or knowing the right dealers. Those things might help, but they're not the foundation. The foundation is accepting that luxury assets are inefficient markets filled with emotional buyers, uninformed sellers, and massive information gaps that create opportunity for anyone willing to do systematic research. Most people will never approach this space that way. They'll keep relying on gut feelings, dealer recommendations, and Instagram hype. They'll overpay for things that are already expensive and miss opportunities that were obvious to anyone actually tracking data. That's fine. Markets need inefficiency to generate returns, and luxury assets will stay inefficient as long as most participants refuse to treat them like markets. But now you know what the research actually looks like. Time on market tracking, geographic arbitrage modeling, condition assessment quantification, comparable sales analysis with statistical rigor. Not glamorous, not exciting, but genuinely profitable for people who execute consistently. The question isn't whether these strategies work. The data proves they do. The question is whether you're willing to put in the unglamorous work that everyone else avoids, because that's where every sustainable edge in this market actually comes from.